So thank you very much for the instruction, Pierre-Henri. Always good here to be at a podium with the flags in front of me. And so really enjoyable to speak from this position. Thank you very much to Better Finance for inviting me to speak here. It is really a very good opportunity to speak here at the 10-year anniversary of Better Finance, and I would like to congratulate Guillaume Prache and the team for what Better Finance has achieved in the past 10 years. We have not always agreed, at least not publicly, I would say, on certain topics, but I fully understand the position of Better Finance and also of Guillaume that retail investors need to make sure that they are coordinated, that they have an association, and also that they make sure that with limited resource they have an impact on the public debates, on policy making, and in that sense I think Better Finance has done an excellent job. So congratulations again. Very good also to be here in Romania. Actually, it's the second time that I have the chance to speak in this beautiful hall of the university. I've been here on a previous visit, visiting here stakeholders and the regulator, and it's really very good to be back here in Romania. I have a number of prepared remarks. They will be on the website, and so if you want to get a bit more detail, then I will share here on the podium. It is available on ESMA's website. And what I would like to do in the upcoming 15-20 minutes is talk about two issues, and issues that were already extensively debated in the panel. It's around investor protection and also the participation by retail investors in the capital markets. And it is very important that we try to increase the participation of retail investors in the capital markets. And I would like to specifically focus on the issue of the costs of investment products, retail investment products, because costs are essential to ensure the participation by retail investors in the capital markets. Retail investors want to know the cost implications of the investment products that they buy, and so to get trust in the capital markets, it's extremely important that they understand the cost related to the investment options that they select. So we'll talk about the legislative framework for costs. So what is the role that costs play in the legislation for financial services? Then I will talk, and Felicia already introduced the report that we published earlier this year with evidence, with statistical evidence on the cost of the various products. And I would like to specifically focus on the active versus passive management strategies of investment funds and what are the cost implications of these strategies. And I also would like to talk about a specific topic which is called closet indexing. I know that Better Finance has put that topic on the agenda a number of years ago, and I would like to update you on what has been achieved on the ESMA side in terms of closet indexing. Now let me first go to the regulatory framework on costs, and the general framework is indeed costs play a very important role in legislation in EU financial legislation, because costs ultimately impact so much on the return, the net return that you will ultimately get as a retail investor. And I would like to briefly mention three areas where costs are important in the legislative framework. And first of all, with the arrival of MiFID II, and there's already been a number of comments made on the regulatory framework, but one of the benefits, I think, of MiFID II has been the transparency on cost. And so there's the obligation to be transparent on the cost implications of the various investment options, both before the investment activity, but also after the investment activity, because it's essential that retail investors see the impact of costs on their long-term performance. Secondly, costs are very important in the case of financial advice and also in the case of discretionary portfolio management. And so in those cases, the costs play an important role when investment firms provide either advice to their clients or they provide discretionary portfolio management. Also in those cases, it's important that cost information is available to the investment firm. There's the obligation for the investment firm to make sure that they are aware, that they understand the costs of the products that they sell as an investment firm or that they offer as an investment firm to their clients. And so in the legislative framework, costs are explicitly mentioned as a factor that investment firms need to understand when they offer certain financial instruments to their clients. And also, they need to be able to justify when they advise a more expensive product compared to a cheaper product. What is the reason for giving that recommendation for the more costly product? The final area that I would like to mention in the legislative framework where costs play an important role is in the area of product governance. And for those that are familiar with this part of the legislation, the product governance framework is both relevant for distributors, so those that are in direct contact with the clients, but also for the manufacturers of financial products. And in both cases, it is essential that the costs are compatible with client objectives, is that charges do not undermine the financial instruments, return expectations, and that the charging structure is transparent and not too complex to understand. I find it, by the way, interesting that the legislation talks about not too complex, which already assumes that complexity is somehow an inherent part of the regulatory framework here. But let me emphasize again how important costs are in the legislative framework. It is part of the firm's duty to act in accordance with the best interest of their clients and should be taken into account when providing advice or offering financial instruments to clients. And this also applies in the world of UCITS and the AFMD. Let me now go to the issue of the report on the actual cost of the various investment products that are available for retail investors and the report that we published in January this year. The report gives an overview for different categories of retail investment products. We've done this together with EIOPA and EBA, and obviously we focused on those products that are available in securities markets. And our report covers UCITS funds, AFMD, AIFs, but also structured retail products. But in all fairness, the detail of the report was really on the UCITS funds because that is the area where we have more information. And I think it was already Felicia that said, in itself, of course. I was talking about the report on the cost of investment products. We focused very much on the UCITS detail, the cost of UCITS funds, and I will get to that in a minute. Many wise words were already said by the panel on increasing participation by the retail investors. It's much too low. The numbers were given by Felicia. I think they may even come from my report, our report, the figures that you shared. But indeed, it only stresses the point. It is important that retail participation is increased in the capital markets because ultimately that is needed to ensure reasonable return on the investments for the retail clients, a reasonable return that cannot be achieved with deposits. Let me now go to a number of key results of the report. One of the first key results of the report is that cost really impacts on the ultimate return that a retail investor gets. And so we called it is a drain on fund performance. And to give you the typical example which is available from the report is that if you invest in a retail equity UCITS fund, so the typical bread and butter fund, retail fund that is available in the EU, over a 10-year period, the gross return is 7.3%. So 7.3% gross return in the past 10 years. The net return is 5.4%. And so the net return is 5.4%. And I should mention that the report was not able to collect evidence on all costs. So in reality, in all likelihood, the actual costs are higher than the going from the 7.3 to the 5.4. This in itself means is that the cost eat out basically 27% of your return before getting to the net return. Another important finding from the report is that costs are relatively constant over time and relatively fixed over time. And so if you take a 1-year horizon, and again focusing on equity funds for retail investors, if you take a 1-year horizon or you would take a 10-year horizon, in both cases the percentage point of costs would be 1.9%. The impact of this is, of the fact that these costs are relatively stable over time, is that once the overall gross return goes down, is that you as a retail investor pay a relatively higher price. You get an extra hit because the costs are not fully proportionate to the variable gross return, and that impacts ultimately your net return. And I think that is an important thing to take into account, is that when there is a more difficult period, when the returns are not as good as you would have hoped, for example, if you look at the past 10 years, that includes the period of the financial crisis, the returns were indeed relatively modest, and so that resulted in this 27% that I mentioned for the 10-year period in terms of the impact of costs. If you go to a 1 year, the last year, it is actually better, because in the last year the gross return for the equity funds was higher and we got only to 18%. Let me then finally make a remark on the difference between institutional investors and retail investors. And what you will see across the report is that typically the costs for retail are about twice as high as for institutional investors. And so for very similar products, the cost charges will be typically double for retail investors. On the one hand, that is understandable, because you could argue it is a more dense distribution network. On the other hand, you can raise the question, is indeed double the cost, is that a amount that is warranted? Let me then finally touch upon, and talking about the report, touch upon active-passive management. As you know, there's this very broad debate, what is the value of active strategies, where they can be, which is more aligned to stock picking, let's say it in that word, or passive management strategies where you follow the index. Well, first of all, we should say that in the EU market, passive strategies are still relatively modest in terms of the share of the total of the UCITS universe. So it's only 10% in value of all UCITS that are following a passive strategy. And that is still relatively modest. We know that in other parts of the world, these passive strategies are much more popular. What the results show is that, although initially at the gross basis, is that there is a marginal superior performance by active compared to passive. However, once you take the costs also into account, this marginal superior performance is basically netted out, is gone away, is not available anymore. And so for the shorter horizons, you see basically is that active and passive perform equal. But if you go to the longer term, it appears that passive outperforms active. And of course, that in itself is an important result that we want to look into further. We will look into that further in the next version of the report. We have started some first analyses of this point of active versus passive. One additional element I would like to mention on the active versus passive debate is to what extent do active strategies at least gives you the possibility of a superior performance. And we looked at the top 25 active strategies versus the top 25% performance for the passive strategies. And what you see there indeed is that the active strategies outperform the passive strategies. So the best performing active strategies do indeed outperform the 25% top passive strategies, but you would expect it. At least that is a result that is in line with intuition. The question, of course, is still, what should be the probability of achieving such outperformance? Let me now, in the final part, of my contribution focus on closet indexing, and it's also called index hugging, to explain the essence of that strategy. The essence of the strategy is basically that in material terms, in strategy terms, you follow a passive strategy, but you charge, and in your documentation, you suggest an active strategy. Of course, that is to some extent, that is a key problem, because it means to some extent is that you don't promise and that you don't deliver on your promise to ensure the active strategy. You don't spend the time and the resources to do the research, and subsequently you charge the fees that are normally fit with the active strategy. We have worked quite significantly in this area. We did in terms of supervisory convergence. We published our first work on this in February 2016, where we identified the share of potential funds that were engaged in closet indexing, so charging active strategy fees, but in reality their real strategy was a passive strategy. We followed up with national competent authorities. We requested investigations into this issue, and we also improved the capabilities of national regulators by holding workshops to how do we enforce and supervise closet indexing. I should also say that we have progressed on the policy work on this issue, and in that context I would like to mention the policy changes that we have published last week. We have updated a Q&A regarding UCITS, and we have clarified issues that are especially relevant for the situation of closet indexing. The first thing that we clarified in the Q&A is that funds, UCITS funds, should be very clear what their strategy is. Are they pursuing an active strategy, or are they pursuing a passive strategy? And so there should be clarity to the outside world on these two strategies. The second change that is reflected in the Q&As is we have broadened the definition of those UCITS funds that are called benchmark referencing UCITS funds. And so benchmark referencing UCITS funds have a certain obligation. They have the obligation to show the performance of the past performance, not only of their own fund, but also the performance of the benchmark they're referencing. And we have broadened the definition for the so-called benchmark referencing UCITS funds, and it means that there will be a broader obligation for UCITS funds to show the past performance both of their own fund, but also of the benchmark they're referencing. And I truly believe that this will help and reduce the risks of closet indexing. Being aware that this will have a significant impact for these funds, we will give them some time to adjust to that and to adjust to that new requirement when they publish their next kit. I should say, and to finalize on the topic of closet indexing, and as also announced at the beginning of my contribution, it's been especially also Better Finance that has raised this issue, and so we have done this work partly based on the inspiration that we received from the stakeholders, because indeed closet indexing is a strategy that we should try and ensure that it disappears in the fund world. Let me conclude not with a summary of my contribution. I think that is sufficiently clear, the points that I made. Maybe one remark on the points made on the ESA review, because it's been quite an important achievement in the past weeks that I would briefly like to comment on. There was the interesting comment of big disappointment by Pierre-Henri. Probably you need to look at this from probably one perspective. The first perspective is my experiences as a regulator, and it might be to some extent be a cynical observation, is that getting fundamental changes in regulatory systems without a big crisis is extremely difficult. You know, if you go back to the origins of all regulatory institutions, it's typically a big crisis that led to reforms. You know, if you go back to the start of the ESAs, they were part of the they were a response to the financial crisis. If you go back to the establishment of the SEC in the US, typically big financial crises provide the momentum for making big changes. And we're weak as societies to do this in an orderly way. Given that background, I'm very happy what has been achieved. I would like to congratulate the Commission, and I know also persons here, and including Felicia, personally, that have really contributed to that, and I'm happy with the progress that has been achieved. On supervisory convergence, I would like to mention one thing which I think is a significant step forward. That is the fact that the review teams will be 50-50%, national competent authorities, ESA authorities, so the teams that will assess national supervisory practices, it will be 50-50, and they will be led by a person from the ESAs. And personally, I think that is a strong instrument that I really value. Let me stop here, and thank you very much for your attention.